Happy to have you here. My name's Ron Ray. If you don't know me, I'm a financial advisor here in the New Braunfels, Texas area, right outside, just a little north of San Antonio. And this is what I do. I teach people about retirement and insurance and money and long-term care and things like that, and help them with it. And kind of what we do, our motto is we help people live happy, healthy, wealthy lives for the rest of their lives. That's what we do here. And today we're here to talk about long-term care. It's a topic that we get lots of questions on. We help lots of people and talk to lots of people about long-term care. And I had a little bit of time this afternoon, so I thought I'd just get on here and just see if I could just reach a lot more people. The technology allows us to give you the education and answer the questions that you want answered right from the comfort of your own home. So here we are with a webinar, and I'm glad you're here. Appreciate that. All right, great. So I'll just tell you just real quickly about myself. My name's Ron Ray. I just mentioned that. I'm a financial advisor, insurance agent here. This is my second career, though. Before that, I was a police officer and did that for a total of about 23 years. I finally retired completely from the reserves a little over 2 years ago. But a few years ago, I decided I want to get out of law enforcement as a full-time career. So I got out of that. I didn't want to have to, work midnight shifts and wear bulletproof vests to work every day. And I wanted to get married and have a family. And it's not the easiest thing to do when you're working in law enforcement. So I got out of that and I went into insurance, and this is what I do now. I've been doing this for about 15 years now, and it's been a good career to me. I get to still help people and do the things that I like to do, and it's been good. So I've got a life and health insurance license here in the state of Texas, and a few other states where I work, or I have other agents that work with me in other states. And I'm also a financial advisor registered with the SEC and the Texas Securities Commission, Series 65 registration. And mainly what my agency here does, Turning 65 Solutions, Tax and Insurance, and Homestead Family Wealth, that's the investment side of the business, is we just help people live out their lives without any kind of worry that they're going to run out of money. And there's several areas, but really 4 primary areas that we work with people to accomplish that goal. And that's health insurance, whether you're just under age 65 and you don't have group health insurance from an employer, we can help you with your individual health insurance. Or if you're turning 65, of course, that's the name of the company, Turning 65. We specialize in you with your Medicare, all aspects of Medicare. Long-term care, which we're here to talk about today, to make sure you don't pay out your life savings to a nursing home if you don't have to. Life and legacy, we want to be sure that you can pay your final expenses and pass along any wealth that you've accumulated in an appropriate manner. And then the last kind of capstone to that is retirement income planning and Social Security planning to make sure that you can live the lifestyle that you're used to without having to worry about running out of money or outliving your money. So that's what we do. A little bit more. I don't usually like to toot my own horn too much, but in this case, it's important to know that I'm not just an internet. I studied on the internet for a couple of minutes before I started giving the presentation. I'm actual, recognized expert in this industry. I train agents and financial advisors all over the country. I speak at conferences. Just got back from one in Las Vegas a couple of weeks ago on Medicare. And I write and contribute to different fairly reputable sources, if you could say that there's any reputable sources in the news media anymore. But currently I sit on the Newsweek Experts Forum as a retirement planning expert for Newsweek. And I write articles for them and contribute to some of their material. So that's me. And that's enough about me. What we're here today is to answer 3 big questions about long-term care. And this is kind of the filter that I run a lot of things through. If I'm getting a sales pitch from somebody, or somebody's trying to get me to do something, the 3 questions that I ask, and these are the 3 questions that you should ask without fail, is what is it, how does it work, and why do I need it? And I think we're going to go we're going to work. We're not going to take those in order today. So today we're going to answer the why do I need it question first, and that's a big question, and one that we get a lot is what's the need? What is long-term care, and why do I need some sort of plan? And whether that's insurance or money set aside or making sure that our kids are prepared, capable, and willing to take care of us, whatever the option ends up being, we need to know why and what it is. Long-term care, just defined by Medicare, is a range of services and support for your personal care needs. It's not medical care. Okay, medical care comes from doctors and nurses, and whether that's at home or in a clinical setting. Long-term care is help with your personal everyday tasks. So they call them activities of daily living, or ADLs. And there's 6 main ADLs, which are bathing, dressing, eating, toileting, mobility, getting around. Those are the main ones when we talk about ADLs. Those are the primary things. Okay, so you need help, some level of help with 2 or more of those 6 activities of daily living. You fall into the category of needing long-term care. And there's different types of long-term care. These are the 3 biggest ones, the 3 primary ones. That would be assisted living, and these go from levels of care. So one of the lowest levels of care is just assisted living, whether you live in a facility or in a community, or it's independent living. You live by yourself, and you take care of most of your needs by yourself, but there's somebody there that's available to handle some of those other tasks for you, like housekeeping, laundry, preparing meals, things like that. It's very minor. You're still taking pretty good care of yourself, but you just need a little bit of help. You need a little bit of proximity to that help. And assisted living can be in one big building, like a dormitory style building, or it can be on a big piece of property, a community type, where you've got your own little cottage or even house or apartment. But it's still the same concept. The next level would be at-home care. So you're getting a higher level of care, a higher intensity, a closer proximity to that care, but you're in your own home. So you live in your own home, but you've got somebody that comes there to help you with those activities of daily living. It could be any of those things, or any combination of those things, or all of them. And it could be from an hour or 2 a week. Maybe you just need help doing laundry once a week, or you need a bath 2 or 3 times a week because you can't get yourself in and out of the bathtub anymore, to full-blown 24/7 close care. And then the next level, and the highest level, is that custodial skilled nursing care. This is called a nursing home or a convalescent center, or sometimes they call it a retirement home. But the proper term for it is skilled nursing facility or custodial care. You're in a facility, you're there, and you have 24/7 nursing care. There's a nurse, an RN that's in charge and oversees all the care. You're closely cared for by licensed, certified nurses' aides, and they prepare your meals, they do your laundry, they change your bedding, they give you your baths, they do everything that you need to do. That's the highest level. In between, there's other things. They're called kind of considered more community-based, where if you're in between assisted living and home care, or assisted living and skilled nursing, you may have your family members or neighbors come help you out. There's also adult daycares, where you've moved in with your kids, or vice versa, they moved in with you, but they still have to work, go to a job. They may take you to what's called an adult daycare. That's another level and form of long-term care. And those are all kind of intermediate, and they serve different purposes. But the 3 main types we talk about, especially when it comes to money, because these are the 3 most expensive types, are assisted living, home care, and skilled nursing facility. All right. Now the need, I've been doing this presentation for a long time, many years. And this is the The last stat that I had was from 2017. It said on average, it came from AARP, by the way, on average, 52% of people turn 65 today, back then, will develop a severe disability. It's going to require long-term care at some point. I did some updating of these stats, a little bit different source. This is longtermcare.gov. These are government statistics. And what it says is that someone turning 65 today has a 70% chance of needing some level of long-term care. So 7 out of 10 of you on the call today are going to need some level of long-term care, whether that's at home, assisted living, skilled nursing facility care. 7 out of 10 of you are going to need some level of that care. And then this goes into a little bit more detail. Women live longer than men. That's just a fact statistically, and they actually need more care, more likely to use long-term care and use it for a longer period of time. And that's 3.7 years. The average length of care for a female is 3.7 years, and for a man is 2.2 years. And then we can see some other statistics down here. I'm not going to spend a lot of time because I got a lot of information out to you, but the main point is 70% of folks who are turning 65 today are going to need some long-term care, and the average stay is 3.7 years for a female and 2.2 years for a male. Okay, so I think the odds are we're going to need it. Now here's the big part. This is why it really matters, is because it's so expensive. This type of care is very, very expensive. And I'm just checking to make sure we don't have any questions as we go along. It's very expensive. The numbers back then when I was doing this presentation, these are nationwide numbers. It's, range from a private room in a nursing home was somewhere between $92,000 and $82,000 a year. A shared room was about $72,000 a year. Semi-private. Updated those numbers today, and you can do this yourself. There's a nice tool. Excuse me. If you'll just Google Genworth cost of care, it'll bring you to this little tool. Genworth is one of the companies that's still in this business of selling long-term care insurance. And you'll see you can put in your zip code, your city, your state. I just kind of selected the whole state of Texas, so we've got kind of a statewide average. And these numbers go back to 2021. So they're pretty fresh, or certainly newer than what I had there. And so for those at home care, just homemaker service, this is not really nursing care. Nursing care at home is usually going to be covered by Medicare, depending on the situation. This is somebody just to help you with those 6 activities a day living. It's going to run you about $4,500 a month. Right. And I can tell you that depending on what you're doing, it's probably going to be more than that. $4,500 a month. That's about 8 hours a day. That's not 24/7. That's for somebody to come in and sit with you during the day. Because I happen to know, because I own a company that does this, that a 24/7 case through my company is going to run you about $15,000 to $16,000 a month. For me to have a caregiver there with you 24/7. So that $4,500, that's we just assume that's about 8 hours a day. So that gives your spouse or your kids, whoever is your other primary caretaker, time to go out to work, go out and get things done, and then your caregiver's there taking care of the household duties during the day. Community and assisted living, full-blown assisted living care, living facility in Texas on average is going to run you about $4,000 a month. And then a skilled nursing facility, of course, this is the big one. A semi-private room, which is what most people have, is going to be about $5,100 a month. A private room, about $7,000. Now that's today's dollars, but let's hope everybody on the call today is not going to need this care right away. So we're always looking into the future. And of course, we know we have to account for inflation. Right? The cost of that care goes up, and And traditionally, statistically, we know that the cost of healthcare rises at about 2 times the standard rate of inflation. So if they tell us that the historical inflation rate is about 3%, we know that's not really true. It's currently, the government's telling us it's about 6.5%. It was last summer, almost this time last year, it was almost over 9%, highest rate in 40 years. So if we also know from the government that the historical rate of inflation or healthcare inflation is about 2 times the standard rate of inflation, then we can set that higher. So this tool allows me to set that rate of inflation up to 5%. So it's still a little bit more conservative or a little bit lower than what I probably think it is. When I talk to people, I tell them, look, we're going to expect the cost of this type of care to go up due to inflation about 6% per year. This tool only lets me do it. 5% is a long way of saying it's going to cost more. So 10 years from now, that home care is going to cost you $7,500. That assisted living center is going to cost you $6,500. And that semi-private room is going to cost you $8,300 a year. Now, depending on where you're at, again, this is the whole state of Texas. Depending on what area you're at, it may be more, it may be less. Where I'm at in New Braunfels, Texas, it costs a little bit more than what the average is, but it's not too far off. Okay, so that's a lot of money. So if we just take the dollars today for a semi-private room, $5,100, and we add that up, that's $61,000 a year times the average stay for a female, 3.7 years on average. That means that's going to cost you $227,000, over $227,000. That's a lot of money. For most people that we work with, that's 25% or more of their retirement savings. And we work with a lot of folks that don't have any money, and that's part of this conversation is what can we do to get those bills paid. It doesn't mean you're just out of luck. I mean, we're still going to be able to get care for you. We just have to do it a different way. But if you have a retirement savings, we don't want you to have to pay 25 or 50% of your life savings out to a nursing home if we don't have to. So my goal here, my job is to make sure that you're not spending your money dollar for dollar to pay for that care. My job is to leverage your money through different insurance and investment strategies so that we're getting more bang for a buck. It's not dollar for dollar. You may be spending 50 cents on the dollar or 25 cents on the dollar for that care. Okay. It's going to cost you something. My goal is for it to cost as little as possible so that you can, your surviving spouse, your spouse who may still live outside that facility still has money to live on, and that your heirs can get what you want them to get in their inheritance. But also, we always get these people come in and they tell us, look, I don't want the state to get my house if I need to go into a nursing home. Doesn't work exactly like that, but I understand what you're saying. The state's not going to seize your house or things, but there are provisions. It's called a state recovery, estate recovery, where if the state of Texas or whatever state you may be in ends up paying for your long-term care through the Medicaid program, they have the ability, it's in the law, that they can go back after you die, after all the exemptions are up, they can go to your estate and recover what they spent on your care. So if there's a house or some real estate or something that was exempt from liquidation when they started paying, now that you're gone and that exemption has gone with you, the state has the ability to go to your estate and recover their costs from those previously exempted assets. Now that gets into some pretty complicated areas where we need to, a lawyer to help us figure that part of it out. We have the lawyers that do that, but I just want to point out that that is a possibility. And so we want to protect those assets now when it's cheaper and easier to do. Okay. So how do we pay for long-term care? And I'll give you a hint, it's not Medicare, because Medicare does not care about long-term care. In fact, Medicare doesn't pay for any long-term care. They might pay for some skilled nursing facility recovery, but it's very short-term, up to 100 days, and you're paying a portion of the bill during that time. And you have to meet certain criteria before you go in. It's in other words, it's considered by Medicare to be medical care because you need it to recover. Well, the kind of long-term care that we're talking about is not medical care. You're there because you need help taking care of yourself. Right? You can no longer take care of yourself on a day-to-day basis. And so now you need this care. Medicare does not consider that to be medical care, and therefore they don't pay for it. Okay. So how do we pay for it? I'm going to list a few here, and then we're going to get into a few of them in more detail. Number one would be long-term care insurance. This is the policies you've probably looked at. You may have had an agent from some company like Bankers Life and Casualty come knock on your door and give you their pitch, and you thought, man, that's really expensive. I don't really want to do that. So that's the first one. Or the next one, if you don't like that, is a life insurance policy that has some sort of long-term care benefits built into it. Then there's asset-based programs where we take a lump sum of your money and put it into a program where we're leveraging your money so that you're not paying dollar for dollar. Okay, so those are the three that we're going to cover in detail in just a minute. But there's other ways. We're going to, if you don't have one of these first three programs in place ahead of time, folks, it's like car insurance. Once you need it, you can't get it. Okay, so once you need this long-term care coverage, you can't get options 1, 2, and 3. Okay, so then we're going to be stuck with 3, 4, 5, 6, and 7. Right? We're going to be stuck spending down your assets before the state will even think about coming in and doing it and helping. All right, we don't want to do that. That's what we're trying to avoid with options 1, 2, and 3. If you're a veteran over 65 or 100% disabled and you served during certain wartime periods, you may be entitled to what the VA calls aid and attendance. And that's money for long-term, this type of care that we're talking about. And it's not all veterans. You have to have been active duty during certain wartime periods. Okay, so World War II, Korea, Vietnam, and the Persian Gulf War, which I'm a little fuzzy reading the details on if that covers the current global war on terrorism, Iraqi freedom, enduring freedom, Afghanistan. Likely that most of those veterans are not old enough anyway, but just to give you an example, that money currently is $2,642 a month for the veteran and $1,432 a month for the veteran's spouse. Okay, that's a good start. That won't pay for all of it, but it sure does help. And if you think you might meet that criteria, give us a call and we can help you apply for it or put you in touch with experts that are in that area. Next would be Medicaid. If you don't have any assets that would exclude you from Medicaid, that's the state of Texas coming in and paying for your care, whether it's at home, if you get a Medicaid waiver, or in a skilled nursing facility. And then number 7 is one that we don't do often, but the question does come up, and I think it does have some viability. That's a reverse mortgage. So you've got a lot of equity, or you may have a lot of equity that's tied up in your home that is not really doing you any good unless you were to sell your house. But maybe you can't sell your house because your spouse still needs to live in it, right? Or you want to pass it on to your kids. Well, you may be able to pull some of the equity out of that home in the form of a reverse mortgage. And again, we're not going to cover that in detail. I think that it is a viable option for long-term care. But we need to have more of a discussion. So we're going to cover 1, 2, and 3, most common and probably the best ways to do this anyway. All right. Let's see. No chat, no questions so far, and there shouldn't be. Whoop. I just blew my screen up. I can't see it. All right. So we'll move on. So first thing we're going to talk about is long-term care insurance, just traditional long-term care insurance. This is where maybe when you were working, your job offered you a plan. Teachers, a lot of times through either the Teachers Association or some other program, maybe the school even offered it. You could buy it as a group plan. And I'm not talking about long-term disability. I'm talking about long-term care, okay? Or maybe you bought it or looked at it independently as an individual policy. This is where you just pay a monthly premium and that buys you a pool of money. Say, I'm going to use an example here in a minute of $240,000. I'll tell you how that breaks down in a little bit. It buys you a pool of money of $240,000 that's designed to last you a certain period of time at the minimum. Okay, so if that $240,000 would be about $5,000 a month for 48 months, for 4 years. So that's going to pay $5,000 a month worth of your long-term care expenses for a maximum of 4 years. Okay, so it's that type of coverage. There's a couple of good things about this type of coverage. There's a couple of, not so good things about it. And one, it's good. It can pay for home health care. It can pay for assisted living. It can pay for skilled nursing facility. It can pay for adult daycare. It can pay for a lot of different things. It can pay for caregiver training. If you are one of your family members is going to be the care provider, it can pay for that. It can pay for respite care. There's a lot of different things that it can pay for. And it does provide that pool of money. So say your maximum monthly benefit is $5,000 a month and you don't use that full amount. Well, that makes that pool of money last longer. So it would go more than 4 years once you triggered it. They do, if you're buying it right, if you're building the policy right so that it's partnership qualified and tax qualified, it will offer inflation protection. So that's very, very important. We said the rate of healthcare inflation is 2 times the regular rate of inflation. So we've got to have that. It's very good insurance. The cons, the bad things about it are it's expensive. By the time you're in your 60s, a lot of times it's just too late to get it because it's just so expensive. Most people can't afford it. I'm going to show you some examples of what it would cost if we were buying it today. I ran some quotes this morning so that we could have some real numbers to work with. And it can be hard to qualify for. So the insurance companies know that it's a very high probability, 70% chance, that if you bought this insurance, they're going to pay out a claim. And so they want to make sure that you're as healthy as possible before they take you on as a risk. So depending on your age, you're going to do a cognitive test, you're going to do a phone interview, health screening. Well, it can be hard to qualify for. And a lot of policies are not just a yes or no qualification. You may have one little thing that doesn't exclude you, but they're going to charge you a little bit more, maybe a lot more because of that. So it can be hard to qualify for. Here's the biggest drawback and the number one reason that people don't buy this insurance is because it's not guaranteed. Okay, it's not guaranteed to pay. You can pay a lot of money for this insurance in the form of premiums and not ever use it, and you're not getting that money back. Okay, and you'll see in a minute that it can be very expensive, and you do run a risk of not using it. Say you paid on it for 10 years, then you died of a heart attack, you're not getting that money back. So that's the number one complaint that we get when people decide not to buy this insurance, is that there's no guarantee that I'm ever going to use it. Okay. And the premiums, by the way, are not guaranteed. They can go up. Okay, so let's look at an illustration of this type of insurance. I ran this illustration, this quote this morning. So these are actual real brand new numbers. And I like Mutual of Omaha for this insurance. There's definitely other companies that are out there. And by the way, I mentioned that I I work with and train agents all over the country. And in fact, some of them are probably on this call right now. So all you agents out there that are screaming at your computer, telling me there's something better out there, I don't really care. For this presentation, I'm going to show the companies and products that are the simplest for me to illustrate the concept. Okay, so just hold your horses. And if you're a consumer and if you looked at some of these things, this is not the only company. This is not the only product. It's not the only product from this company. But again, I've got a short amount of time to get the information to you, and I want to get it to you in the simplest, most understandable manner possible. So this is what we're going with. So this is just a traditional long-term care insurance policy for Mutual of Omaha. It's for a 65-year-old female with what they call select, but it's just a standard rate class. So it's not preferred, but it's not rated up for health either. Okay. And we went with a 5,000. I need to get my thing here because I realize you cannot see my cursor when I'm pointing at something. So a $5,000 maximum monthly benefit that will pay for a maximum of 48 months at the maximum benefit. That gets you a pool of money in $240,000. Now, why did I pick $240,000? That's because that's very close, as close as we can get with this particular policy to that $227,000 need, right? So we said the average stay for a female is 3.7 years, and the average cost is $67,500 a year. That's $227,000. $240,000 is pretty darn close to that with just a little bit of cushion, okay? Now it pays 50% for assisted living, because we know assisted living doesn't cost quite as much. And so what that's going to do is it's going to make that benefit last a little bit longer. That pool of money last a little bit longer. Pays 100% for home health because it costs as much or maybe even more, right? And it's got a cash benefit for home health of $1,250 a month. That's a little bit different. That's if you don't need that full-blown at-home care, but you've got some expenses. They'll actually reimburse you in cash up to $1,250 a month. It's got a 90-day elimination period. I want to point this out to you. This is like a deductible. Almost all of these policies have an elimination period, although you can buy up to a 0-day elimination period. It gets pretty expensive. Just think about that as a deductible. Your health insurance has a deductible, your car insurance, your home insurance, they all have deductibles. That means that's a certain amount of money that you have to pay first before the insurance company will come in and pay. So think about that. This policy is not going to trigger, it's not going to start paying until you've been in care for 90 consecutive days or 90 days. Okay, so just elimination period equals deductible, and it equals 90 days. Okay, the inflation protection is 3% compound lifetime inflation protection. That means that every year on your policy anniversary date, the benefit, this is going to increase by 3% compound interest without any increase in the premium. I said the premiums aren't guaranteed. They can go up, and that's true, but they're not going to go up just because of the inflation protection. Now, that inflation protection benefit costs money. You can buy it with 0 inflation protection. You can buy it up to 5% lifetime. 3%, that 5% lifetime compound inflation protection benefit is expensive. It costs a lot of money. 3% we know is not really enough, but it's the best we can get and still have it even close to reasonably priced. It is partnership qualified. We'll talk about that in a minute. Well, might as well talk about it now for just a second. That means that when it comes time to apply for Medicaid to get the state to help pay, let's say you've lived long enough, you live past that 3.7 years, and you've exhausted your pool of money, this $240,000, you've exhausted that, and now all your assets are gone, and now you need the state to come in. The state's going to come in because you don't have insurance anymore and you don't have any assets, and because you did the right thing. You bought an insurance policy in the eyes of the state. You bought an insurance policy. that met the qualifications and it's partnership qualified, that means that the state is going to disregard that amount of money, $240,000, from your estate before they will come in. Okay, so that means that you can still have $240,000 of assets, non-exempt assets, that normally you would have to have spent down, or they can get from the estate recovery program. They're gonna overlook that. They're gonna let you keep that. Okay, so partnership qualified. It's also tax qualified. That means that the premiums that you pay up to the limits to the IRS are tax deductible. Okay, I'm going to skip because I already can tell I'm going to be running short of time. Look at the premium: $6,700 a year, $608 a month. That's a lot of money. That's why I always say, look, folks, by the time you get in your 60s, it's too late, either for health reasons or money reasons or both. It's just too expensive. Okay, maybe it's not too expensive for you. Maybe you can afford that. It's risky. I'm not saying this, you shouldn't buy this. I'm saying you should have a plan, but I just want to point out, let me clear this. I'm going to point out the premiums. And remember, this is for one person. This is just for the wife. Okay. The men, believe it or not, this is the one area of insurance where women actually cost more, just because statistically the insurance companies know they're more likely to pay out. The husband's going to die of a heart attack. Okay. Or something else statistically. So men actually cost a little bit less than women for long-term care. It's the only area of insurance where men catch a break. So for this one, it's $608 a month. But remember this annual payment as well, $67.62, and that's a pretty good policy, and from a good company that's been in the long-term care business for a very long time. Okay, but again, pros and cons. It's a very good policy. It's going to take care of you. Cons are it's expensive. It's hard to qualify for. And you have a risk of paying a lot of money. Say you paid into it for 10 years and you died of a heart attack. That's $67,000 you're never going to get back again. Okay. But it's called insurance for a reason. And that's the risk you take. Okay. It's just like your car insurance. You know, you pay for it for years. And if you never have an accident, nobody ever hits you, you're not getting anything back. So that's option number one. If you don't like the idea of that, or maybe you've got something in your medical history that you can't qualify for it because it is difficult, the next best option would be a life insurance policy that has living benefits. Now, folks, these are in most cases, these are cash value, either universal life or whole life policies. And if you're a Dave Ramsey fan and you don't like that, I'm going to ask you just to stick with me for just a second. Okay. I'm going to ask you to stick with me for just a second. I have to say that because I myself am a Dave Ramsey fan, and he's never buy, whole life, cash value life insurance. I go just a little bit farther and say, unless it's for a very specific purpose. Okay. And for a very specific purpose would be long-term care, because you can't get anything. So, Rod, to answer your question real quick, the cost of the insurance on option number one, the long-term health, that can increase. All right, those rates are not locked in. Okay, due to inflation, claims lost to the company, they can raise those rates. And in fact, you better count on that they're going to raise the rates. And I think, I didn't go and grab this statistic, but I think the average is over the course of a lifetime about 20%. Okay. Now, life insurance. Here's something that one benefit, one pro to the life insurance is in most cases those premiums are locked. The premiums are never going to go up. Internally, the cost of the insurance does escalate, but you don't realize that in your premium payment. And you also don't realize it in the long-term care benefit. So remember, I said we want to, in my opinion, as a fiduciary financial advisor, I don't like buying life insurance as an investment. So I like the Dave Ramsey theory of buy term life and invest the difference. I will make one exception, and that's for long-term care, because we're not worried about the death benefit so much. We're worried about the long-term care benefit. Okay. So I got to move quick. This is generally a whole life policy or a universal life policy that has living benefits. Now, that's a fairly new feature. By fairly new, I mean in the last 20 years. There may be some of you on the call that have a whole life policy that they bought, when you were 30 or 25 at work, or you just bought it from, I don't know, Woodman of the World way back when. And just because it's a universal or a whole life policy, it may not have these benefits, but I can tell you, I can look at the policy features and tell you whether it does. But almost all new policies have some form of living benefits, meaning you can have access to the death benefit before you die to pay for certain types of care. Terminal illness care, chronic illness care, long-term care sometimes falls under the same category as chronic illness care. So a few years ago, insurance companies got smart and they said, the only type of insurance plan that is guaranteed to pay out is a life insurance policy, especially a permanent life insurance policy. You're going to die. Okay. I know we don't like to talk about it, but you are going to die. Two things certain in this life is death and taxes. Okay. You're going to die. Right. And if you have a permanent life insurance policy and you keep up the premiums, that policy will pay out. Okay. So insurance companies got smart a few years ago and they said, what if we let you have access to the death benefit before you die? It's a little bit of a selling point for them. It doesn't really make them anything. In fact, I think over time, it probably costs them money versus being able to hold on to your money as an investment on their side of the portfolio for longer, and then finally pay out as a death benefit. Just actuarially, I think it's probably in their benefit to do that. But as a selling point, they put these living benefits in there that said that if you need it for certain triggers, long-term care, terminal illness, or in some cases, chronic illness, we'll let you have some of that death benefit before you die. And so that's what we do. Now, the pros to this type of program are, one, it's easier to qualify for. For most policies, it's just fairly simple underwriting. They're not underwriting them as long-term care nursing home policies. They're underwriting them as life insurance policies. So we don't have the cognitive testing in most cases. It's just, if it's a fully underwritten case, which most aren't, they're actually simplified underwriting now. You don't even have to do a blood test and urine test. You don't have to do what's called a paramedical exam, where a nurse comes to your home or your office and does the exam and gets blood and urine and all that. You don't have to do that. It's called simplified underwriting. It's simply just a phone interview and a prescription, a check of your prescription history and a check of your they call it MIB, Medical Information Bureau, your medical records. And if they don't see any X's in there, you're good. And you could even have some beginnings of some cognitive impairment. I don't want to make any promises there, but if it's on your medical records, maybe they could say no. But my point is, the whole point with that is it's much easier to qualify for than traditional long-term care insurance. Okay, it's usually less expensive. It usually costs less, not in all cases, but usually costs less than a long-term care policy. And there's no risk of losing that premium, because even if you were to pay on it for 10 years and die of a heart attack, your beneficiaries are going to get that tax-free death benefit. So somebody's getting that money back, whether you get it in the form of long-term care benefits or your beneficiaries get it in the form of the death benefit. You're getting more money back than you put in. And that's always my goal. My goal is to get you more money out than you get in. Except in the case of health insurance. I don't want you to get money out of health insurance if we don't have to. All right. Now, what are the drawbacks? A lot of these plans do not have inflation protection. So that policy, that death benefit, which equates the long-term care benefit, is set. It does not go up. The other thing, oops, let me get rid of these phone calls. Once it's set, it's set. There's no inflation protection. So we either have to take our chances with buying a smaller policy and hoping that, we'll have enough other assets to cover the inflation, in several years, or buy a policy that's big enough to cover what we feel we'll need in several years. If we do that, sometimes, the premium goes up. So we've got to kind of talk that through and do the math and see what might be appropriate. Okay, so that's what that is. Let's look at some examples. Here is an example of just a straight universal life policy from a company called Protective Life. Very good A-rated company. It's a $250,000 death benefit. That's the face value. And based on the terms of the they call it accelerated death benefits, long-term care rider. I'm going to call it a long-term care rider just for simplicity's sake. It will pay you if the rider's triggered by you being unable to perform 2 of those 6 ADLs. It will pay 2% of the death benefit on a monthly basis after a 90-day elimination period. So it's still got that 90-day elimination period. Okay. So, and that equals $5,000 a month. Okay. For, until that death benefit is expired. And this is one of the only policies like this that will actually pay out 100% of the death benefit. So as much as I possibly can, I'm trying to compare apples to apples. It's really hard and almost impossible to get a true apples to apples comparison because we're talking about different types of products. But I'm going to try as much as I can to have the same benefits. And I'll just point out some differences as we go. But for the most part, they're going to be very close. So the long-term care policy was $5,000 a month for 48 months maximum. Oops, I did it again. And this policy is $250,000. That should be easy math, but it's not. I got distracted and had to do it on a calculator. 50 months. So we're getting 2 extra months out of this one. And this is kind of what it looks like on a table. Now this policy, it's got inflation protection on it. This is a little bit different one. I may have missed some slides here. So this is just your basic policy. And I'm sorry, I'm missing something. Because let me turn this off, see if you can see it. There you go. I had the section covered up with the premium. This policy costs $6,062 a year. So that's very, very close to the same cost, very close to the cost of the long-term care policy. So almost apples to apples premium wise, you get the same benefit, but without the more difficult underwriting and without the risk of losing that premium dollar if you never use the long-term care premium. Now, what if you went into a nursing home and you stayed for 2.5 years? What if you were only in there half the time? Well, whatever's left goes to your beneficiaries as a death benefit. So if you only end up spending $125,000 of the $250,000 death benefit, whoever's behind, your spouse or your kids, whoever your beneficiaries are, will get the remaining $125,000 as a tax-free death benefit. Okay, so that's the Protective UL. Certainly, there's other companies that do this. I like North American, Minnesota Life. There's others. This is one of the companies that we use most often. Their underwriting is pretty easy, and for our purposes here on the webinar, their illustrations are pretty easy to read. Okay, the next one. There's one other type of policy that I want to show you. That falls in the life insurance category. It's a whole life policy from a company called One America. This is their asset care plan. This plan is actually built for long-term care. So it's got 2 segments. It's got the life insurance plan that gives it the life insurance characteristics tax-wise of a life insurance policy. And then on that, it's got a long-term care rider that gives you essentially 2 times the death benefit for the purposes of long-term care. Now, here's where I was pointing out. This one has, unlike most life insurance policies, has inflation protection. However, that inflation protection is pretty expensive, like I mentioned. So here we're getting that $250,000 long-term care pool of money, $5,000 a month from day one. But this policy is costing us $9,100 a year. So it's quite a bit more then it's 50% more than the long-term care or the universal life, but it's got that inflation for protection. So if we go back to this one, that $250,000 death benefit, there's no inflation protection in that. You buy that on day one, that's what it's going to be in 10 years. Okay. This one, we go back, this one has inflation protection, 3% a year for the first 20 years. So you see, year one, you've got $250,000, $5,000 a month of coverage, but it goes up 3% compound every year. So in 10 years, you've actually got $326,000, $6,500 a month of long-term care coverage. You've only got a $125,000 death benefit, and the death benefit is paid first. If we trigger the long-term care benefit, they're going to pay the long-term care, the death benefit out first. So if you get $125,000 of long-term care money out of this company, you're out of death benefit. If you died at that point, your beneficiaries get zero, you got $125,000. If you live past that, if you outlive that $125,000 benefit, well, now you've got an additional $200,000, and of course that goes up. The long-term care benefit, not the death benefit, goes up every single year until the 20th year is when the inflation protection runs out. So if you make it 20 years, say you're 65 now, and you don't need long-term care, you need to go into a nursing home until you're 85, you've now got $438,000, $8,700 a month worth of long-term care benefit. Okay, that policy costs $9,100 a year, and it's a 30-pay plan. Now listen, if you pay into this for 30 years, what is that? That's a lot of money. 91.55 times 30. That's $274,000 in premium that you paid on this plan. That's a lot of money. And if you didn't use it, you're only getting $125,000 back. So you can look at it, that long-term care policy cost you $150,000. But if you end up using it and you exhaust those benefits, then you got $451,000 out of it. So it's expensive. I think for most people, this particular policy is not going to be affordable. So I got you an option that shows you what it costs. This is the life insurance premium. They combine them. They separate out the long-term care premium, $48.90, because it is designed like the long-term care policy to be tax deductible, of course, up to the limits that the IRS allows. Okay, man, I feel like I'm going really fast. You guys go ahead and type in any questions that you have. I just have limited time, so I want to make sure I get everything out to you. This is what the premiums are in that same policy without the inflation protection. So compared to the protective policy, the universal life policy that we just looked at call it $6,700 a year, this policy without inflation protection, this policy without inflation protection only cost you $5,800 a year. So almost $1,000 a year less for essentially almost the same long-term care benefit. I think I got this quote before I made an adjustment. So it's not the $5,000 a month. You could add another $10,000 on here and it would bump that up just a little bit, not too much, not to $6,000, I don't think. So almost $1,000 a year less for this particular policy, but it's only got a $120,000 death benefit. Okay, so I like this one too. I think the inflation protection is pretty expensive, but that's kind of across the board. So those are the first two options, and we'll recap them real quick. Long-term care insurance, and if you don't like that idea of taking the risk with that premium, or you can't qualify for it because that underwriting is more strict, then option number two is a life insurance policy with living benefits that we just illustrated. So I'm going to take about a 10-second pause and give you a chance to type in any questions. And I think I'm going to be okay on time. If you've got some questions, I'll be able to answer them. Give you just a couple of seconds and I'm going to move on. Keep typing your questions though, and I'll answer them as they come up. Okay, options one, and 2. Option number 3 is a little bit different. Okay. Option number 3 is an asset, or this. So this shows you, I'm going to go back 1 second. This shows you the cost of that inflation protection. It's a lot. It's about almost $3,000 a year for that inflation protection rider. Okay. Option number 3 is an asset-based program. Now, in most cases, when I say asset-based program, what I mean is a fixed annuity that has a long-term care insurance rider. Now, this is not to be confused with a fixed indexed annuity that has a long-term care or home health care doubler. That's a different thing. I don't think it's nearly as much of a value. It does have value, but it's not going to work this way. So let me show you this. The pros to this are your money stays your money. You're going to put a lump sum of money into this annuity. It's going to stay there nice and safe. It's not invested in the markets. You're not going to lose it to the stock market or any other kind of risk, market risk. And it's going to earn a nice, respectable rate of fixed interest for the life of the policy. But it's got this rider on it. Oh, and by the way, you die or you change your mind, you can have your money back. Could be during the first few years that there might be a surrender charge, much like the life insurance policy. If you cash it out early, you might pay a surrender charge. We'll talk about what that is. But once that surrender charge period is over, either 8 or 10 years, depending on the annuity, there's no more surrender charges. So if you got to the 11th year and you changed your mind, you decided you didn't need the long-term care, you didn't want it, you can have all your money back with interest and no charges or fees. Okay. But let's assume that you didn't buy this as an investment. You bought it for the long-term care properties, the long-term care riders. What it does is it takes your cash accumulation value, so that's your principal, your initial premium, plus the interest that it earns over the years, and it triples that money for the purposes of long-term care. Now, the pros to this are, number 1, your money stays your money. There are some fees, but they're very low. I'll show you what they are in a minute. Very, very low compared to the first 2 costs that we just looked at. It does have inflation protection that doesn't cost anything. It has much easier underwriting. So it does have some underwriting for the long-term care rider, but it's simplified underwriting. It's pretty easy. There's about 6 questions that I recall, and it's pretty easy to qualify for. Right? Here we go. Here's an illustration. This particular one is from a company called Guarantee Income Life Insurance Company, Gillico. It's called the Annuicare annuity. And what we're trying to do is get to that $5,000 a month, maximum monthly benefit. Now, in this case, for Gillico, they illustrate it as a maximum daily benefit. And there's trains of thought or schools of thought on a daily benefit versus a monthly benefit. I'm kind of more in the daily benefit camp. And what that means is that if you're in a skilled nursing home, skilled nursing homes tend to bill on a daily basis. And you might not, or even home care might bill on a daily basis. In fact, in case of home care, it's hourly basis, which means that if you don't get care on a certain day, well, insurance company doesn't need to pay that benefit. And they're not going to bill the insurance company, in this case, Gillico, for that benefit, which makes it last a little bit longer. If it's a monthly benefit, they're just going to pay the monthly amount in full, usually, depending on how they bill. And then, so that amount, that policy may not last as long, okay? So that's really kind of a minor thing that I just thought I'd point out, but that's $165 gets us very close to $5,000 a month, which is actually 166.66 cents. So it gets us very close to that amount. So what they do, and in order to get to that number by the end of the first year, we would have to deposit $118,500. So this is for people that have Accounts. Maybe you've got a CD, you've got a brokerage account, maybe an IRA, although I don't like that as much because of the way they treat qualified money in this thing. No time to go into that here, but we need to talk about it. I'm not saying no to an IRA or 401k type money, but there's some things we need to talk about. Savings accounts, you've got money set aside that is maybe you've earmarked it for long-term care. You're thinking about that's what it may be used for, or you just don't know what else to do with it. Maybe you don't like bank rates. Maybe you don't like the risk that you're taking in the stock market. This is a really good, I think, alternative. So we take $118,000, and you can see that right here. This is the annuity side, and this is the long-term care side, right? And this is let me restate that. We're going to take $118,000. This is the guarantees. This is the minimum, and this is the current. So the current interest rate is 2.9%. Yes, I know current interest rates are higher than that. This thing has been at over 3% for about the last 10 years, and recently they dropped that. I'm not sure why, but I can tell you that it's guaranteed to never go lower than 2.75. That guarantee rate has actually come up. It used to be 1%. So that's actually really good. But every year, every 12 months, the rate is variable. It can go no lower than 2.75 contractually. It's a fixed rate of interest. It's similar to a CD. You know exactly what you're going to get every year, no more, no less. Okay. So if you put in $118,500 next year, your cash value is going to be $120,890,000. Now there's a surrender charge. So remember, if you cash it out in the first year, you're going to pay a surrender charge. It's pretty hefty, right? It's going to cost you $10,000 to get out of this thing in the first year. But it is I think we did a 10-year policy on this one. So you'll see at the end of the 10th year, that surrender charge, first of all, the surrender charge drops every year. Every year, that surrender charge ticks down just a little bit so that at the end of the 10th year, there's no surrender charge. The accumulated value equals the surrender value. Okay. Now this here, it says monthly premium deduction. This is the fee. This is the cost of the long-term care rider. And you can see it's very low. For a 65-year-old female, is 0.95% of the accumulated value. So that's $93.81 a month times 12 is $1,125 a year. So compare that $1,100 to the $6,000, $7,000, or $9,000 that we were just going to pay for that life insurance policy and that long-term care policy. Okay, so that's the only fee that you pay in this thing, is that long-term care rider fee, which is 0.95% of your accumulated value. So every year your accumulated value goes up. Every year your premium goes up just a little bit, but the percentage doesn't go up. Okay. And that buys you a daily maximum benefit amount at the end of the first year of $165.60 per day times 30 days in a month. That gives us $4,968. So very close to $5,000. Now the maximum benefit on this, which I cannot change, is 6 years. So that buys you a pool of money, in other words, of $362,669. That's at the end of the first year. But this one, because it earns interest every year, 2.9% over here, call it 3%, make math easy, 3% over here in your cash value equals 9% over here in your long-term care benefit, excuse me. So this one's got essentially, for long-term care purposes, 9% annual inflation protection. Okay. And you can see that benefit goes up. If we were to get to the 10th year, say you're 65 now, you needed care at age 75, you got $196 a day, or or $5,900 a month, or $430,000 of coverage, which equals the maximum daily benefit for 6 years. Okay, if we get to the 20th year, your cash value is $174,000. Your maximum daily benefit for long-term care, 238 times 30, is $7,100 a month, $521,000. Now, what if you die? Do you get the long-term care number, or do you get the accumulated value? If you die, even during the surrender charge period, which is the first 10 years in this example, we can't go lower than that. If you die during the first 10 years, the surrender charge is waived for death and long-term care, okay? You only pay that surrender charge if you cash out early. If you say, I'm going to break the contract and I'm going to get out early. If you die during that surrender charge period or after, what do you get? You get the long-term care number, you get this, your beneficiaries get this, or do you get the accumulated value? The answer is you get the accumulated value. Right? And they're going to pay out for long-term care purposes, just like that life insurance policy we talked about. They're going to pay your money out first. Okay. And if you exhaust all of your money, then they're going to start paying out on your behalf. So essentially what you're getting is, let's say, let me clear these out. If we got to 10 years, you've got $143,650 of your cash and $430,950. So if we do 430,950 minus what your share of that is 146.50. In other words, if you were to get that maximum daily benefit for the benefit period, 6 years, you would have gotten $287,300 out of the insurance company's pocket. So that's our goal. That's what I aim to do. I want to get you into the insurance company's pocket as quickly as possible. Okay. And this is one of the best ways to do that. So that at $196 a day, sorry, I'm doing some math here. I should have done this before the presentation, but it just occurred to me. At $196.78 a day, that's 730 days. That's 24 months to exhaust. I may have done that wrong. Anyway, you get into on an average stay, you're going to be spending about half your money and about half their money. So this is a very good option for people who can't qualify or don't want to take the risk with a long-term care policy, can't qualify for or can't afford the life insurance policy, because those are pretty expensive. They're either equal to or more than, depending on the inflation protection option, more than a long-term care policy. They are easier to qualify for, and you do get your money back if you die early. This is for people that have some money sitting around, but you don't like options 1 and 2. And my money's sitting around, I don't take that phrase lightly. This is, you want your money to do something for you, okay? And it is. It's going to earn a nice, rate of interest, safe. There's no risk, no market risk in this. So earning 2.9% with no downside risk outside of the last 6 months or 12 months is, that's pretty nice. You really couldn't get a deal like that when CDs, the same type of safe money at a bank, was paying 1% or less prior to this, these rate hikes. This was still paying, 2.9 or 3%. This is for that kind of money. Now we've got a couple of minutes, so I'm going to go ahead and explain what I meant by it. I'm not as big of a fan for this type of program for IRA type money. It's because this is not a qualified plan. So what they're going to do, because we don't want, see, if you were to pay for this out of your IRA, just say we didn't have the annuity, we wouldn't have this. We were just using your money out of your IRA. Every dollar that you take out of that IRA or 401k type money is going to be considered ordinary income for tax purposes. Okay. The benefit from this program, if we were to trigger this and start getting that long-term care or even your cash value, in the form of a long-term care daily benefit, that's tax-free. That's all tax-free money. Well, the IRS doesn't let us mix those two things. Okay, so we can't take taxable money, IRA money, and turn it into tax-free money, not without paying something. Okay, so what they do is we can put money into this from an IRA, and it's still an IRA. But what the company is going to do is, over the course of 5 years, they're going to convert that into non-qualified money. So they're going to show 20% of that money per year for the first 5 years as a taxable distribution to you. Okay, so if you put in, let's say we'll just use this example, so we're using real numbers, $118,500 every year for the first 5 years, they're going to convert 20% of it. So they're going to show, and they're going to 1099 you for $23,700, and you're going to pay income tax on $23,700. Now, it's not huge for most people. That's not going to make a big difference. You're going to pay the taxes on it, but it might not affect your Medicare. It might not pull in more of your Social Security for taxation. We just have to do the math and talk through it. If all you had was an IRA, you didn't have any non-qualified money, I think this is still a really good plan. We just have to do the math. That's all I'm trying to say. Okay, but then after they do the conversion, they send you the 1099. You pay the taxes on that. So let's say you're in the you're in, let's say, maybe the 22% tax bracket, which is pretty high for a retiree, I have to say. But your effective tax rate might only be, let's say 12%. So, you're talking about maybe $2,800, maybe not even that much worth of income tax on that amount of money per year. So I got a question. What about using a tax-free RMA to cover the initial annuity? By RMA, do you mean required minimum, maybe RMD, required minimum distribution? Because you could, if you're already taking RMDs, required minimum distributions, because you met that age, which, by the way, if you've not started because you're not old enough, they just bumped that age again this year to 73. Sorry, if you're already taking them, you're not grandfathered in. You have to keep paying. If you're already taking required minimum distributions, you got to get that money out of that account anyway and pay tax on it. That's just Uncle Sam's way of getting this money before you died. Then, yeah, you can take that money. You don't have to spend it. You just have to pay taxes on it. You could put it into a program like that. Not RMD, pension roll over to an RMA. I think let me answer that one offline, because I'm going to probably have to look that answer up. I don't want to give you bad information here. I'll look it up for you. Okay, so again, those are the best three options that we have that leverages your money to pay for long-term care. Okay, if you don't have assets, you don't have money to buy one of these programs, to invest in one of these programs, or set money aside in one of these programs, then there are other ways to pay for your long-term care. That's usually, we're going to be looking at Medicaid or reverse mortgage, care and attendance aid from the Veterans Administration if you qualify for that. There's other ways to do it. Okay, but for most people, if you have assets that you want to protect and not pay dollar for dollar for your care, these are your best three and probably your only three options. Now, I say options, but I gave you three concepts. Within each one of these concepts, there's lots of different products, there's lots of different companies, there's lots of different ways to set it up. It's all very customizable. And so again, I know that I can picture the agents that are watching this right now pointing at me going, "Now there's this other product from this other company, it does better." Maybe so. I picked the ones that are easiest to illustrate the concepts. This is a very conceptual conversation today. All right. So we may be wrapping it up. I went pretty fast. So this is what this looks like in another table. We put a initial deposit of $118,500. The long-term care rate was 0.95%. That's the fee rate. So that initial premium, first year premium, is $1,125. Now remember, that goes up because it's a percentage of your accumulated value, and your accumulated value goes up every year by that fixed rate of interest. Now I want you to, let me go back one. The interest rate that they're paying is 2.9%, but you got 0.95% coming out. So that's not your net gain. If you were using this for an investment, it's probably not your best option. We can get you better rates. Okay. I want you to use this for the long-term care benefits. So, 2.9% minus 0.95, your net rate of return, if you never took long-term care benefits, is 1.95% a year. Okay, so it's not great. Better than CDs were a few months ago, and CDs will probably go back to in short order. But I can tell you, I've been working with this particular product for a long time, and it's been at or near 3% for the last decade, I would say. So it's pretty stable. And the company it's a good A-rated company. I've worked with them for a long time. I like their financial stability. I like the way they do business. I like the way they treat my clients and they treat me. Okay, so just to go over some of the internal benefits of it, it does have a 90-day elimination period. So they call it a deductible period, and I like that. It has can pay for caregiver training, $500 in a lifetime. The annual benefit for care planning is $500. You may want to hire. There's people out there that specialize in planning your care. They're called. They have different names, but they generally kind of a blanket term would be a certified care manager or certified geriatric care manager, case manager. And they're just kind of a person that comes in and is a hub and puts together all of the members of your team, which may include an elder law attorney. It may include a home health care company. It may include an insurance agent. It may include an estate planning attorney. And that person, that geriatric case manager, does that for a fee. They get paid. This plan will actually cover some of that bill. It pays a little bit less for adult daycare, about 50%, but the daily maximum benefit covers home health care and skilled nursing, which would also include assisted living. So pays out very well, very, very similarly to a long-term care insurance policy. It's easier to qualify for, it costs less, and you have much less risk of losing that premium. One, because the premium is very low, and two, if you change your mind or die before you ever use a long-term care benefit, you or your beneficiaries are getting that money back. Okay. All right. Let's see if there's any other questions. Just to recap, what do we talk about? What is it? It's long-term care. How does it work? There's three main concepts that I work with that provides leverage. That's a long-term care insurance policy, a permanent life insurance policy that has living benefits, or an asset-based program like a fixed annuity. There's also an asset-based program that would kind of fit into the category of life insurance. It's more of a single premium life insurance policy. Works very similarly to the annuity policy. It's got some drawbacks too. The surrender charges are usually quite a bit higher, but we can talk about those. I didn't include them in this because I just wanted to keep it simple. All right, why do you need it? Because long-term care is expensive, and 7 out of 10 of you that are listening to me, watching me today, are going to need this care. I promise you. All right, so here's my offer to you today. I'm going to put it up on the screen. There we go. You should be able to see the button there. It goes to my calendar. Click that button. It'll take you straight to my calendar. You can schedule an appointment with me to go over these numbers for you. So my offer is to you, come in, meet with me, let me run these numbers for you. There's a little bit more planning that goes into it. I actually calculated these numbers using this insurance 100% to pay for your care. I did not account for Social Security. I didn't account for pensions. I didn't account for rental. I didn't account for any other income. All of this likely, I kind of gave you like almost a worst case scenario. All of these numbers are likely to get dialed down quite a bit because you do have other money that's going to go for your care. And so we want to account for that. So these numbers are likely to be a bit lower than what I showed you. I kind of showed you a worst case scenario. So let me run these numbers for you. Let me get your numbers and show you what it's actually going to look like for you. And if you do that, you spent, gosh, an hour and a half with me today. Everybody's kind of stayed on. Nobody's left that I can see. Appreciate that. That makes me feel good. So in exchange for that, in exchange for you coming in and spending another hour with me, let me do this for you. I'm going to give you 2 free gifts. One, normally you would go to a seminar like this at a restaurant, and myself or whoever the advisor was is going to buy you a big steak dinner and spend a lot of money on you. But there's about 6 people in a room of 40 that are actually interested in what I have to say. The rest are just there for the food. And I don't mind that. It's just the cost of doing business. But in this case, I want to give you that steak dinner too. So if you come in, let me do this. I'm going to buy you a steak dinner. I'm going to give you a $100 gift card to the restaurant of your choice. If you want to get a $100 gift card to Sonic, I'll buy you one of those. Doesn't matter to me. So you do that, and I'll give you that free book from Patrick Kelly. Patrick Kelly's one of the authors that writes some of the simplest, most easy to understand books on retirement that I have been able to find. The one I'm thinking about, I think I have one here close enough to me to show you. It's called Stress-Free Retirement. Very, very good read, very simple to understand, puts a lot of these concepts into very easy terms. And I just love it. My clients love it. I use it to teach agents. You want to learn, what I do, read this book, but I also use it with clients. I give it to clients, point out certain things. And I'm going to give it to you. I'm going to buy you a steak dinner. Agents, sorry, I'm not buying you dinner. You should be paying me for this education. So I'm glad you're here too. All right, let me go back to the chat, see if there's any other questions. I think we're going to about wrap it up. And Zeke, we'll get back to you with that answer. If you're available for a call right after, I may give you a call. Just type yes or no. I'll give you a call here in just a few minutes. All right, folks, I got to give you some disclosures. The SEC requires me to tell you, all these things. I'm not going to read it to you. I'll put it up there for a few seconds. You can read it if you want to. But that's about it. If there's no questions, folks, listen, man, I really appreciate everybody being here and spending the time with me as usual. A lot of you are already my clients. Some of you are not. You've probably never met me before. I really appreciate you being here. Appreciate you taking the time at your lunch break on a Friday. Have a great weekend. If you're near us, we're expecting some bad weather tonight. Be safe, and we'll be here if you need anything. Don't forget that button right there. If you're ready to schedule an appointment, that'll take you right to my calendar. You can schedule it to your convenience. If you're not ready to do that, give me a call or an email on Monday. Have a great weekend, folks. Thanks.